Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures little changed as the S&P 500 looks to close out a modest week of gains. What started off as the so-called debasement trade this week quickly turned into the buy everything rally. Stocks soared to new highs, gold hit fresh records, crypto jumped, and the dollar saw its best week of the year. Investors also bought treasuries for good measure. Plus, the Bureau of Labor Statistics is reportedly preparing to release the September CPI report despite the government shutdown closing the agency. The BLS is calling back staff. The agency was directed by the White House Office of Management and Budget to bring back employees to assemble the inflation report. The data is necessary to calculate the size of next year's Social Security checks. It will also, of course, factor into the Federal Reserve's next rate decision. And Levi Strauss sinking after its earnings report. While the company raised its full-year outlook, it did warn it's starting to feel the effect of tariffs. Profits are growing more than Wall Street expected thanks to targeted price increases and a shift away from wholesalers. Revenue was $1.5 billion in the third quarter, in line with estimates. Meanwhile, Beyond Yoga, Levi's athleisure brand, also performed better than expected. Let's get a check-in on stock futures right now. We are seeing futures push very slightly higher here. All three major averages pointing to modest gains of around 0.1% at the open. Let's dig into our top stories of the day now. Futures edging higher to wrap up the week as the debasement trade, or at least talk about it, continues to take center stage. Plus, Levi's raising its full-year profit forecast, but still disappointing Wall Street. And the Bureau of Labor Statistics calling back staff to work on preparing the September CPI report. Joining me now, senior reporter Brooke DePalma live at the NASDAQ, Federal Reserve correspondent Jennifer Schonberger, and senior markets reporter Ines Ferre. Ines, I actually want to start with you here. And this debate that has been raging over the AI trade, whether it's a bubble, whether there are these circular concerns around it, we've had a little bit of pushback happen over the course of the week.
Yeah, we have. We've seen some heavyweights on Wall Street basically talking about this concern about the bubble. Goldman Sachs this week saying this is not a bubble yet. They point out that the leaders, these leading companies, the ones that have been leading the returns, are the ones that have had the strongest balance sheets. UBS also sort of coinciding with that viewpoint, saying, look, despite these concerns, despite the risks within the AI trade, they still they still believe that investors should stay engaged in these markets. They point out that global AI capex is expected to grow 67% this year. Also talking about the strong balance sheet of these companies as compared to their counterparts during the dot-com bubble. And basically saying that investors should put allocations in during dip buying, that they should buy the dip. The problem is that there have been very few dips to buy. You are looking at the NASDAQ, which has rallied some 50% since the April lows. You're also looking at the S&P 500 that has rallied considerably since the April lows as well. In fact, the NASDAQ was trading at around 15,000, just above 15,000 in April. And look, it's at 23,000 right now. So certainly it's been a big V-shaped rally, and that has been concerning to strategists, basically talking about the valuations. Are they too stretched here? Don't chase this rally, and that there could be a pullback. The catalyst, though, still is unknown.
Well, and while all that is going on, there is all this talk about the dollar debasement trade, Ines, but the dollar is actually bouncing right now.
Yeah, that's right. I mean, we have seen a consolidation of the dollar, and since around mid-September, we've seen the dollar going higher. And so right now, the dollar's at a 2-month high. The big bet this year was to short the dollar because the trend has been a weaker dollar. And it seems to be that it may be a bit of a crowded trade. You've got a lot of hedge funds that have been shorting the dollar that has left them sort of vulnerable to the dollar creeping higher. If the dollar goes up considerably, this could unwind some of the favorite trades that we've seen on Wall Street. Some of the precious metals, they have done considerably well during a weaker dollar period. So you could see an unwind there if you see the dollar going higher. But make no mistake, it still has been a year where the dollar the U.S. dollar index is down about 10%, almost 10% year to date.
Yeah, although a lot of that decline, of course, coming in the first half of the year, as we just saw on that chart, and then kind of going sideways. Let's talk about the other thing that we're paying a lot of attention to, and that is data, the lack of when we might get it. Jen, the Bureau of Labor Statistics now says they are going to bring back folks to calculate CPI, although we're not quite sure yet when that consumer price index is going to come out, right?
That's right, Julie. You have it exactly right. The Bureau of Labor Statistics is calling back some furloughed workers to promptly begin work on the consumer price index for September. That was originally supposed to be due out next Wednesday, October 15th, but clearly going to be a little bit of a delay here because workers are just going to be starting on that. And the statute requires that the Social Security Administration calculate the annual cost of living adjustment for Social Security benefits using third quarter CPI data, and that needs to be released before November 1st, hence why they're calling back these workers now, given where we are in this government shutdown. And a senior administration official told me that these security benefits do continue because there is funding there despite the lapse in appropriations, and that it would be it would cause substantial damage if the Bureau of Labor Statistics did not complete these cost of living adjustments for beneficiaries. Of course, we also know, Julie, that this is critical data for the Federal Reserve, and the Federal Reserve has been flying blind with a dearth of government data. And so, clearly this is going to be released before November 1st. Hopefully it comes before the Fed's meeting, which is scheduled for October 28th and 29th, and that will help them make an informed decision.
And then, Jen, we're watching Fed speak as well, because those guys aren't on break. They're still out there making speeches. And Chris Waller speaking this morning. I think Austin Goolsbee is speaking later this morning. Waller also happens to be reportedly on the list of potential candidates to chair the Fed. What do we take away from some of these comments?
Yeah, that's right. Fed Governor Waller was interviewed this morning on CNBC. And he was asked about the search for the next Fed chair. He said his interview with Secretary Bessent went very well. It was very focused on economics. It wasn't political at all. He also talked about his outlook for the path of policy and how he sees the job market right now. And even though the Fed is flying blind and did not get that September jobs report, we did see the ADP report show that payroll gains actually reversed and turned negative in the month of September. And Waller basically said that underscores that the job market remains weak. Yet he did say that the Fed needs to remain cautious and move in 25 basis point increments. So that's kind of a departure from his colleague, Fed Governor Stephen Miron, who is looking to move in larger increments more quickly to get to that so-called neutral rate on interest rates. That's the level that's designed to neither spur nor slow economic growth.
Interesting. And also, I guess, putting a little bit of space between himself and what President Trump might want, which is intriguing. And then, Brooke, we have, as we've started to get earnings, kind of try to parse through what does all of this mean for the consumer. And we have now the denim index, so to speak, that is Levi's reported.
Yeah, Levi's reported a quarter that ended up beating Wall Street's expectations on both the top and bottom line. And that was largely driven by not only this belief that denim is going to be the next big thing and people are going to dress in denim from head to toe and that momentum heading into the end of the year, but also we heard some caution, prudence guidance around what exactly the end of the year could look like. And that's why you see the stock moving lower this morning. It's down about nearly 11% in pre-market hours because of this Q4 guidance that the company put out. They do expect organic net sales to only increase by about 1% in the fourth quarter. Now, for comparison, in Q3, that same metric grew about 7%. And I was listening in on the call last night, and the CFO, Harmit Singh, did say that the prudent guidance is being just conservatism on the macros. He went on to say that they're not seeing any underlying change in the trends, and they think that they really are well set for the holidays. But that only 1% growth after a quarter where you're seeing 7% growth is not really what Wall Street wanted to hear. They also updated their fiscal fiscal 2025 outlook for the rest of the year back to where it was prior to that April metric. But once again, it disappointed the street. It wasn't exactly as robust as what Wall Street wanted to hear. So certainly Levi's set the bar low for themselves heading into this holiday season, which is pretty key for all retailers, including this company that has really been on this turnaround strategy to get more consumers in their stores.
Brooke, Jennifer, Ines, thanks so much. Appreciate it. Coming up on Morning Brief, we'll bring you today's top trending tickers and count down to the opening bell. We'll be right back. Now time for some of today's trending tickers. We are watching Qualcomm, Applied Digital, and rare earth stocks. First up, Qualcomm. China reportedly probing the company for suspected violation of its anti-monopoly law. The scrutiny comes amid its acquisition of Israeli chip firm Autotalks. That acquisition officially closed in June, just over 2 years after it was first announced. This latest announcement from China likely increasing tensions between the U.S. and that country ahead of meetings between the two nations later this month. Next up, Applied Digital, the data center company topping first quarter revenue estimates and reporting a better than expected loss per share for the quarter. It also said it's in advanced talks with a hyperscaler client for its second data center campus in North Dakota. Shares of neocloud companies like others, CoreWeave and Nebius, for example, getting a boost after the results. The big revenue beat was driven by tenant fit-out revenue from CoreWeave. Applied Digital began to ready a data center for its use by installing power, cooling, networking, and other infrastructure. And looking at rare earth stocks as well, they're extending gains on reports that China is tightening its grip on global rare earth supplies. That has investors speculating the U.S. government might take additional positions in companies in the space. This week, the White House said it would take a 10% stake in Canada's Trilogy Metals. That adds to its portfolio of companies that the Trump administration says are active in areas critical to national security. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, investors have been flocking to precious metals, cryptocurrency as well, with gold, silver, and Bitcoin all reaching new highs in recent days. But moves in the Treasury market don't necessarily suggest the so-called debasement trade is gaining steam. Joining us now, Michael Gousset, Principal Asset Management Chief Investment Officer of Global Fixed Income. Michael, thanks for being here. So as we look at this sort of debasement trade narrative, if indeed people were thinking that the dollar was in danger of debasement, wouldn't we see different activity within the Treasury market?
Yeah, good morning, and 100% correct. That is the big story here is that there's inconsistencies around the behavior of the dollar this year versus the behavior of U.S. assets, whether that's fixed income related or even equity. We are seeing, that most of the demand still remains very high for U.S. assets, and the dollar implications are some of the uncertainty that your previous guests were talking about around government shutdown, tariffs, the place of the U.S. in the global world. But overall, we're in a position where there's a breakdown of that debasement trade.
And I mean, do you think there even is a debasement trade, or are people just trying to sort of describe something that's happening and put sort of rational parameters around it and trying to explain it in some way? Or do you think there was and it's faded? Like, what's happening here?
It doesn't appear to us that there has actually been a debasement trade, that there is not there. The dollar is a function of supply versus demand, just like any other asset. And when investors globally start to get concerned about the uncertainties that have evolved over the past 9 months of U.S. government behavior, they behave in a manner that's consistent with that concern in the value in how they're positioning the dollar. Tariffs are a big part of that. And so, I think that there is a view that perhaps the U.S. dollar was a bit overvalued, and that's showing up in the way that it's traded this year, rather than there being this flight away from U.S. assets or concerns about the long-term health of the U.S. dollar.
Michael, as we take a step back and look at the fixed income market right now, at a time when the Fed is at the early innings of a rate cutting cycle, what does that imply then for investors and where they should be positioned within fixed income?
I think the big message I would leave is that there is a real need for income globally. You have an environment in fixed income, which is providing that income today. Yields remain relatively high on a near-term historic basis, and investors should be thinking about opportunities to lock in these types of yields to create income streams on a go-forward basis. Historically, when the Fed is in a rate-cutting cycle, fixed income does well. You see the entirety of the yield curve decline. And so not only do you have the opportunity to create income today, but you also have the potential for total return in the fixed income markets.
Well, and that's an interesting argument because we know that with yields in the last year or so, the highest that they've been in some people's investing lifetimes, if they're younger, sure. Right? So is it going to take some convincing to tell people, well, you should get in here even if you're getting a lower yield than you were a year ago?
I think there is some concerns that maybe that ship is already sailed and that people missed it. But as to your point, a lot of recent behavior would suggest that these are attractive entry points for getting into create an income portfolio again, or even a potential for total return. I am unfortunately old enough to remember trading much higher interest rates 20, 30 years ago. But the environment that we sit today, which is that there is more demand for income. There's more demand for fixed income from hedgers. It's unlikely to see that longer term interest rates are likely to be meaningfully higher anytime soon.
And what about where we are in the economic cycle and whether the Fed is going to be able, there was the whole debate over whether they were going to be able to engineer the soft landing. They seem to have done that, but I guess the fight is not over, right? So there is still some concern about them cutting into what is still a somewhat inflationary environment. So how concerned are you about that?
So I think the Fed's in a tough spot right now. You have the two legs to their stool, which is stable prices and full employment in conflict right now. Inflation rates, although much lower than we were a few years ago, are starting to creep back up a little bit. The unemployment rate has been slowly rising over the last year and suggestive that the potential that the unemployment situation is deteriorating. And the Fed's kind of caught. What's more important? What should be their focus on a go-forward basis? And as we evaluate the data, we think, yes, inflation affected by tariffs is likely to creep higher through the remainder of this year. But like the Fed governors have said on a number of occasions, it's more likely to be transitory, one-off, whereas the employment deterioration is real. And that is going to become the bigger focus for the Fed as we go into 2026. And in our minds means that there's likely to see more meaningful Fed rate cuts than even what's priced into the market.
Michael, I want to ask you about something sort of that's been a little bit of a sideshow in the credit markets, and that's the collapse of a company called First Brands, which is an auto parts supplier. But there are sort of implications for non-bank lenders, for the credit markets, for that side of the system. And I'm just curious how closely you're watching that and whether you have any concerns about the private credit markets related to that.
So it is something we're watching closely. No doubt it does have implications on how people view those private asset classes. It hasn't shown itself to bleed through significantly into the public markets as of yet, but there is some concern that the same investors that are holding these private assets, that there may be more of these issues revolving around things like First Brands and others, they're also holders of public markets. They can get liquidity in public markets. So that is something we're keeping an eye on and do have some concerns about. The private credit markets, have been where money has been flooding for the last couple of years. And, that continues to be a dominant source of demand for fixed income markets. That segment hasn't really been through a real credit cycle, a real economic downturn. And so we are watching very closely to ensure that there isn't some systematic issue that revolves around that private credit market if there is a real recession. Now, if things continue in this stagnating kind of growth environment, then probably everything's going to be okay. But if you were to experience a real recession, boy, you're going to learn a lot about the health of and the liquidity of those private credit markets.
Yeah, indeed. Michael, thank you so much. Good to see you.
Thank you.
Thanks. Coming up on Yahoo Finance Opening Bid, executive editor Brian Sozzi is the host of that program. I'm sure he's going to bring us a lot of puns in the next 30 minutes. I'm looking forward to that.
No puns, Julie. Well, I will say it's unlikely the government will reopen on my show in the next 30 minutes. So we're going to go into all things, everything rally, crypto, AI. It's been a heck of a week. And then we're going to go back into all things government with Connecticut Governor Ned Lamont. Looking forward to talking to the governor.
I look forward to watching that interview. Brian Sozzi, thanks so much.
See you later.
Keep it right here. Opening Bid is next.